Good afternoon, members, and welcome to the Fat Profits Macro webinar. It's Thursday, 17th of August. I'm Andre Obies. Joining me today is our founder and CIO himself, Angus Geddes. Welcome, Angus. How are you?
Hi, Andre. Yeah, very well, thank you.
Great. And of course, our Chief Operating Officer, Patrick Ganley. How are you, Pat?
I'm great, Andre. How are you? Angus, good afternoon.
Good afternoon.
Good afternoon. All right, so before we start, let's go over the usual housekeeping. Disclaimer: all our presentations are general information only and should not be construed as personal advice. If you are in need of specific or personal financial advice, please contact your financial planner or advisor. And of course, past performance is no indicator of future performance. Now, towards the end of today's webinar, we have our usual Q&A session. You can ask one question apiece. I suggest you type in your questions as they come to mind. You will find that in the sub-menu here, as indicated by the orange arrow, and we'll try to address them all as time permits. All right, in case you can't hear us, please call the toll-free 1-300 number at the bottom of the screen here. I'm sure our staff at the office would be happy to help. All right, so let's go on to the market updates. Angus, turning this over to you.
Yeah, look, it's been a fairly interesting week. I think, look, just without sort of going through all of the indices, we've seen pressure coming through in all the major stock markets this week, and I think a lot of it's really got to do with the fact that we've seen the 10-year bond yield push up towards 4.3%, the highest level in 14 years, which is definitely weighing on equity markets, particularly some of the more expensive tech stocks and growth stocks, which are rate sensitive. We've also seen an increase in the US dollar, and that's weighed on commodities, and that's had a bit of a negative sort of a blowback into the Australian market. Plus, we've also seen a lot of bearish sentiment out of China, and the media waves this morning were dominated with what concerns in terms of what's going on in the Chinese property market, and and how the government's going to turn the economy around.
The S&P 500 testing key support and a 50-day moving average. This is quite an interesting chart, and I know it's something we've been talking about for a while.
Yeah, this chart is interesting in that we've seen support break down below the 50-day moving average. The S&P 500, I think it's fair to say, is fairly decisively broken down through that support level. So essentially what this really does is it raises scope now for further downside extension. Now, given the huge move in the S&P 500 from 36 to 4600 this year, a correction and a pullback was always going to be the order of the day. And I guess the critical question now is how much further is this corrective sell-off got to go. It's entirely plausible that the S&P 500 pulls back to 4200, which would be a correction in the vicinity of 10%. Now, whether it goes further than that, we'll have to wait and see. And we are moving into a typically volatile period, a seasonally weak period, which is September, October, certainly August, end of August and into September. So I think this correction's got further to run.
And where do you think it would stop, Angus? If you were going to just make a call, do you think it's going to what level would you be looking at?
Look, I think the 4200, 4150 level, where the 200-day moving average kicks in, and that is going to be the next sort of major support for the S&P 500.
Okay, thank you. So the NASDAQ 100 was testing the primary uptrend. I know it's something we've been talking about a lot, and you're talking about the bond rates going up, which is putting pressure on the tech stocks. So we're still seeing that at the moment, aren't we, Angus?
Yeah, I think that's fair to say that, Pat. You know, the NASDAQ 100 is dominated by those mega cap tech stocks, where, you know, we've seen decent sell-offs coming through in those stocks. But of course, you know, a lot of them are still 50, 60, 70% up from where they were in October last year. So, you know, all we're really seeing now is a bit of consolidation. I think in terms of the NASDAQ 100, if it breaks this primary uptrend, then it risks further downside extension. And, you know, given the mega cap tech has led the market this year and has been out in front, you'd also expect, you know, the same group of stocks to lead the market on the downside during a correction. And I think, you know, it's also plausible that, you know, there's further to go on the NASDAQ 100, and we could see it sort of back at that 13,200 level, representing the breakout level of earlier this year.
Okay. Next slide, Andre, please. So crude oil correcting following the breakout, Angus. I know it's something you and I chatted a little bit about this morning in relation to the oil price and energy. So, you know, this is quite an interesting topic, and I know it's something that you're pretty focused on, which is the energy sector at the moment, which brings us just to this chart on oil.
Yeah, I mean, look, I'm bullish on energy, and Pat, and we've sort of talked about which stocks would we be chasing, and, you know, obviously we haven't been sort of going after the tech stocks. I think the energy stocks make a lot of sense at the moment, given that they are on low valuations. They're quite sort of impervious and sort of resilient to higher bond yields. And from this chart, we can see, you know, there's been a bullish breakout with the WTI crude price. Of course, you know, this week we have seen some of that rally correct. You know, we've seen a bit of a correction come through. The WTI oil price has come back $5, you know, primarily on, you know, probably on, you know, all the sort of bearish sentiment surrounding China. But look, the technical setup of oil looks, I think, pretty encouraging, and technically, you know, quite bullish. There's nothing extraordinary about this pullback. I think, you know, the oil market will find a decent amount of support in the mid to high 70s, and then begin to reassert on the top side. And it's interesting with this pullback in the indices this week, we haven't seen too much fallout in the energy stocks. And by the energy stocks, I'm really talking about oil and gas producers, the uranium producers, and the coal producers.
And maybe we should just touch on again the energy stocks that you're focused on at the moment. I know we've spoken about them before, but maybe we just give members a recap of a couple of those names, which I believe will be Santos and Woodside.
Yeah, look, I think they are the highest quality names in Australia, Santos and Woodside. In Japan, I really like Inpex, which has got a huge LNG operation in Australia as part of its portfolio. That's the largest oil and gas producer in Japan. And I also like Shell in the UK market. So, you know, those are my four top sort of global picks in that space. And, you know, I think, you know, given, you know, the markets are now beginning to react to these higher bond yields, you know, this is a good place to be.
And we're still sticking with the theme of uranium. I mean, that's still something we're focused on. And obviously we updated the website this week. We put a buy on Paladin on the research reports, but I know it's a theme that you've been looking at quite a bit, Angus, and you're still focused on that.
Look, I am bullish on uranium, Pat, and I think, you know, given the imperative to do something about climate change, given that renewables are going to play an important part, but it's going to take some time. Nuclear using, you know, small modular reactors are a great way to go in terms of shoring up power to the baseload. And I think a lot of countries are looking at it and building these smaller reactors. So given that there hasn't really been much in the way of new supply of uranium, it's looking very bullish for spot prices, which have inflected after a multi-year consolidation. So I think the uranium space looks interesting. The coal stocks, not great for the climate. I get all of that. But, simply the coal price is allowing them to generate huge cash flows. So, and pay big dividends to shareholders. And, we're not going to be able to get off coal tomorrow. And then, of course, we've got LNG and the oil producers. And again, I think the underlying dynamics are pretty encouraging. We're seeing Saudi Arabia exert quite significant price control through production cuts. And it's going to take, a much higher oil price really to get the United States to come back as a dominant producer. They're simply just not putting money into the oil and gas industry in terms of bringing on new supply. So yeah, I'm still bullish on the oil and gas and the energy complex and uranium, Pat.
And commodities in general, Angus? I know it's something you've been talking about, and
yeah, I mean the world has to eat. Today I put a chart up of orange juice, which was a multi-decade highs, and I'm sort of seeing decent inflections in a range of commodities across the spectrum, and I think that given what's going on in Ukraine, I'm still bullish on the grains. I think they're in for a decent re-rating after a fairly punishing correction over the past year. And all the soft ags I think look good.
And with gold, Angus, how you feeling with gold at the moment? I mean, obviously it's been under a little bit of pressure here. You mentioned the US dollar coming or going up,
so
but
what are you thinking there? No change really to what we talked about last week, and that is, near term, commodities and gold are under a little bit of pressure with this stronger US dollar. And it's all about the dollar. And, overnight we saw a breakout in the dollar index, which, could potentially see the dollar extend higher, up to 105 in terms of the dollar index. And, there's a real probability of that. And, that near term, that could put some pressure on, on gold. But, my big picture outlook hasn't changed. I think, what's driving the dollar up at the moment, it's those rising bond yields and the perception that the Fed might have one more hike left in them. That remains to be seen, but that seems to be what's driving it. Those widening interest rate differentials in the favor of the US. So, we need to keep an eye on it. But look, I don't think this changes the picture. And, I'm looking for a renewed downtrend in the US dollar. We've talked about de-dollarization. Every day it seems another country is looking to diversify trade away from US dollars and trade in their own currency. So I think this is a real trend that's only going to accelerate. And, that's going to be bearish for the US dollar over the medium to longer term. Secondly, the Fed's got to be getting close to the top of their tightening cycle, whereas I think a lot of other countries are probably going to have to keep going. We saw those hot wage inflation numbers come through in the UK. They're going to have to keep going. That's going to, put a bid back under the pound. If the Bank of England have to raise rates. Similarly, I think we'll see that take place in Japan as they sort of normalize their monetary policy, and which will bring about some strength in the yen. So near term, dollar going higher, precious metals correcting. Probably got a bit further to go, but I don't want to be losing sight of the bigger picture. And I think that the gold is definitely in a major bull market. It's going to go a lot higher as soon as we get that inflection point in the US dollar.
Okay, Andre, next chart, please. HS Tech tracing out a bottom, Angus. This is an interesting chart, and I know it's something we've spoke about last week as well. Maybe you just want to comment on this and what's going on here.
I thought this was a good chart to bring up and talk about. And really, if we listen to the media, there's a lot of doom and gloom and bearish sentiment around China. And quite rightly so. I was writing about it, the problems in China this time last year, and that they've got some real issues in their economy. I think what's interesting about the Hang Seng Technology Index, which is really an index of all the mega cap Chinese stocks, which unlike their US counterparts, which have multiples of 35, 45, 50 times. In Hong Kong, a lot of these mega cap stocks are trading on multiples of 10 times. And whilst, we've seen all this bearish news in the media this week, we haven't actually seen the Hang Seng Technology Index, break down below that support level. Doesn't mean to say that won't happen, but it looks to me like the index is tracing out an important bottom. And if we look through to the actual earnings reports, they were actually really pretty good. They were very solid. Like Alibaba reported very strong numbers. Tencent reported some really good numbers, but they were knocked around with a fine that they had to pay to the regulator. So it sort of says to me that maybe maybe the Hong Kong, the sell-off in the Hong Kong and the CSI 300, which is the mainland Shanghai Shenzhen Composite Index, maybe that's nearing an end. Time will tell.
Okay, Andre, let's move on to the next chart, please. Next. Okay, so questions and answers. I guess a couple things that we wanted to touch on, Angus, was you and I had a chat this morning about cash levels, and you were holding a little bit more cash in the past. You've moved quite a bit of that cash, not all of that cash, but a bit of that cash back into the market. And I think most of that cash moved into the energy stocks, which is where you placed that. Is that accurate?
That's a very accurate summation. We've taken a moderate, we've upped our exposure to the energy sector. That's really the principal move that we've made in the past month. And we've added some of those large cap energy stocks to the portfolio, with the view that the oil price is inflecting higher. We've taken a position in uranium via Paladin and URA, which is the global ex uranium producers ETF, on grounds that the uranium price is inflecting higher. The industry dynamics look really attractive, and a modest position in some of the coal stocks. So in Whitehaven Coal, actually, in Australia. So energy's really been the big recipient in terms of where that cash has gone. And we've also taken a very moderate position in some of those Chinese technology stocks, which seems to me like there's a bit of capitulation going on there at the moment in terms of investors throwing the towel in, particularly given some of those strong earnings beats. If you look into the results, the results were really solid. I mean, Tencent had, in terms of its operational revenues, I think the biggest jump in 5 years. So I think we're at an interesting point. I think there is further risk to the US correction. That can definitely extend on the downside, but that market is led on the upside. And we're still keeping some cash, Pat, still keeping quite a bit of cash in our portfolios, and we'll be looking to deploy that hopefully, over the next next 4 to 8 weeks.
Okay, and I thought we might touch on one stock that I know you've become quite interested in the gold sector, which is Red 5. I believe you still think that's quite interesting at the moment.
Yeah, they gave a really good presentation and update of the diggers and dealers. And it's, it's basically a story of, expanding reserves, expanding production. And, given to where the shares were trading a year ago, or two years ago, I think it's sort of 20 cents. They look interesting. We've taken a moderate position in Red 5, and of course, I think with the gold stocks, the best way to play them, of course, is not to put all your eggs on one of them. It's you really want to kind of diversify some of that company-specific risk away and hold a basket of them.
And that's probably the same thing on the uranium. I know, we've got some members interested in uranium, and we've kind of mentioned the ETF that you like, which is quite an interesting way to play it, because it's a basket of uranium stocks, which should limit or reduce some risk there. Is that still your view on that, Angus?
Yeah, absolutely, Pat. We want to play the uranium price through underlying equity exposure, but the ETF is great because it's a diversified basket comprised of the world's largest uranium producers. And so, you've diversified your company-specific risk in terms of playing it. URA, for example, holds, a decent position in Paladin. It's got quite a lot of Cameco in it, which is the world's largest uranium producer. But there are other major uranium producers in there as well. So there's some diversification.
And Angus, with the rising bond yields, do you think that'll have a negative or positive impact on the gold price?
Look, it's having a negative impact at the moment because it's pushing the US dollar up. It's pushing the US dollar higher. And, we've seen the dollar rise. We've also seen real 10-year interest rates rise. And, so that has been a bit of a headwind for the gold price. But, I don't see this as a new major upward leg in the US dollar. I think whilst it might have a bit further, the dollar index might have a bit further to go, the rally is going to run out of steam. I mean, we did get that breakout above resistance on Wednesday, and which says that, the greenback can run a bit further. But, and those rising bond yields are a tailwind for the dollar. But, I think, the US bond yield could get to 4.5, could get to 4.75. That, we might begin to see, the US yield curve begin to sort of settle down, which sort of says to me that, US dollar weakness could begin to sort of start coming through, later this year.
Okay, and with the US dollar, Angus, do you see anything out there that could, come left field that would dramatically impact the US dollar at this stage?
Well, we saw the downgrade, the Fitch rating downgrade of US debt. The US, that wasn't great for the dollar. Look, I think we've got this underlying de-dollarization trend. There seems to be announcements, news about that coming through every day now. Today it was a company in India trading directly, buying oil directly from the United Arab Emirates and paying in rupees. That followed another transaction the other day, which involved a gold purchase, which is financed in rupees. And I think, this moving away in terms of denominating your trade is going to become a big headwind for the greenback. The other point to make is the US bond yield is going up. That's also a sign that the appetite by international buyers is drying up. And we know that the Chinese are selling down their US Treasury position. They've been selling that down for a while. And, by definition, if you sell your US Treasury bonds, you're probably going to get out of US dollars. And Japan could be the next. Now, Japan are the largest US bond holder in the world, outside America, largest foreign owner of US debt. And given that their own bond yield is now going higher and they're normalizing their own monetary policy, we're going to see probably a lot of switching by the Bank of Japan. They're going to start switching out of US bonds and potentially back into their own JGB bond market. So I think that could be a wild card that could come out of the woods in the next 6 months.
Okay, I think that wraps up most of the questions that we saw come through, and I think we've had a good conversation today. It's been obviously an interesting week in the markets, as you said. We obviously got another couple days to go before we can call the weekend end, but I think we're probably done for today. And I'd like to thank everybody that joined us today for the webinar, and thank you, Angus, and thank you, Andre. And we look forward to catching up with everybody next week.
Thanks, Pat. Thanks, Andre. And thanks for everyone joining us today. And we'll look forward to joining you next week. In fact, I think next week, Pat, you and I are on the Friday podcast.
Yes, we'll be on the podcast next week. And just members that are looking for the uranium ETF, they're all published on the website, as is the Paladin recommendation. So, take some time to log into the website and you'll see those recommendations on the member area. So thank you, have a great day, and we'll talk to everybody soon.
All right, see you all next time.